Besides a financial advisor, who do you need on your team as you build wealth? Welcome to Beyond the Advisor, the show where we gather members of Gatewood's team of diverse specialists to break down complex financial planning questions. Our goal is to provide education to families and business owners that empowers them to build their wealth with purpose and confidence. Welcome back to Beyond the Advisor, episode 4.
Big deal.
Big deal.
Always a big deal.
We're going through them. So today we will follow the same profile as last time. So our last episode went through a hypothetical client scenario that we see very often. And so we'll talk through that. This one is going to be, should we invest a lump sum today, all in, or over time? And so this is something that's very critical to clients. And it's a hard decision because it can feel a little nerve-wracking, I think, to put it all in at once. But we'll talk through some behaviors and we'll talk through some of the research and come up with what we generally recommend.
Yeah, no, I love it. And I love this subject because it often happens unexpectedly, right? You all of a sudden receive an inheritance or you get a business payout and it wasn't planned for. And I think to your point, it can feel emotional just as much as mathematical in these types of situations. So yeah, I'm excited to dive in.
Before we dive in too much, I'll do a quick introduction. So I'm Nina Breen, Senior Wealth Planner at Gatewood Wealth Solutions, joined by Micah Alsobrook, our retirement plan consultant.
Awesome. Well, are you ready to jump into the case?
I am.
Okay, another fun one. In this client snapshot, we have a married early 50s couple, one child that's in college,
Okay.
$5.5 million net worth, $300,000 to $400,000 in annual income. They recently received a $1 million inheritance.
Okay.
It's currently sitting in their bank account in cash, and they're pretty hesitant to invest.
Yeah.
They feel like the market's too high right now, and they're not sure what to do.
Sure.
Is this a common scenario that you see, Nina?
Absolutely. Absolutely. So and it doesn't really matter kind of what the market's doing. So a bad market can make it feel even more nerve-wracking, but I think it's always kind of a difficult jump off to put everything on all at once. So we see this a lot. We always go back to the plan. So everything that we work through, all the recommendations we make are always in light of the financial plan. So before I jump into how we would kind of walk through that, I want to go through a little bit of the research. So Vanguard actually did a really fantastic study on this topic. And so they looked at over several time periods if it would have been better to put all of the money in day one, lump sum, all into the market, or to dollar cost average over time. And the majority of the time...
Can I pause you? You said something that people may not know.
Yeah.
Dollar cost averaging. Can you elaborate on that?
Yeah, thank you. So dollar cost average means we say on a set period of time, we're going to put a set number of dollars in to work on a systematic frame. So maybe it's a certain dollar amount. Maybe it's $100,000 a month for
Spread
10 months. Maybe it's $50,000 a month for 2 years. Maybe it's $250,000 a quarter for a year. So it's just some sequence of time, some set dollar amount that we're putting in.
Got it.
And then the reason behind that is it really kind of takes the behavioral decision making out of it.
Got it. So it's more spread out and consistent.
Yeah.
You know when you're going to do it each time.
Exactly.
Okay.
And the client buys in on the front end.
Okay.
So we come to whatever amount of money and time frame they're comfortable with, so that we work together with them, and then they feel good about it as it happens. They don't need to make the decision each time.
Got it. So you were saying, sorry to cut you off.
No, that's okay.
Yeah.
So the research showed that the majority of the time it was more effective to put it in as a lump sum day one.
Interesting.
And that's really just time in the market. So not timing the market. But there's always that possibility that, because I think it was 68% of the time the lump sum ended up being more profitable. But there's always that 32% where it wasn't. And so you don't want to hit that point. So oftentimes we'll work with clients on, what are they comfortable with? And we'll probably put some amount of lump sum in on day one and then put the rest in a systematic way over time.
Got it. Does the time horizon that they have... I guess in this example, they're in their 50s.
Yeah.
They have one child in college. Mm-hmm. Does that age frame change your approach at all, or is it really independent of age?
So it does change my approach a little bit. depending on the specifics of this client. So for someone in their 50s, so when you're 10 years out from retirement, we really start to kind of plan for that retirement. And so at that point, we'll want to work toward, likely we've got 12 months worth of cash built up for clients who are in the later stages of their careers. And so if depending when they're looking at retiring, if they're still 10 years out, we're probably fine with that 12 months. But if they're in their 50s and they're retiring it, in the next couple of years, then we'll want to make sure we first fill up that cash buffer. So that 2 years worth of cash as really being the needs off the portfolio. And then everything else can be put to work long term.
Got it. So to summarize, 10-ish years approaching retirement, 12 months in cash would be sufficient.
Yep.
If you start getting 5 years or less, maybe,
Yeah.
to put it 2 to 5, inching your way up to 24 months or 2 full years of cash is going to be critical before you decide what else to do.
Yeah.
Okay.
So anything that we're going to need in the next 2 years, so maybe there's a lump sum for the college in that scenario as well. Anything you need over the next 2 years, we want to make sure is not subject to market volatility.
Got it. Okay. What else should people think about? I know based on this case, they were somewhat risk averse based on the description used. Does that inform where you put the money?
Yeah.
What options do you have? What tools do we have?
Absolutely. So we always start with the client's comfort level. So likely a client who has a $5.5 million net worth, they probably already have some amount in taxable investments that in an allocation that they're comfortable with. So say $1 million of their 5.5 is in taxable investments. So that's an account that's funded with after-tax dollars.
In a brokerage, it's an example.
In a brokerage account. It's grown.
Yep.
And anything that we sell would be taxable at that time. So they've probably got some amount of taxable investments in an allocation they're already comfortable with that we've decided together. So maybe since they're in their 50s, maybe it's 70% equity, 30% fixed income. And so it's really designed for growth still, but not super aggressive. And so if they already have the account set up that they're comfortable with in an allocation, that's a no-brainer. We'll just combine it in with that account. If they don't have a taxable account yet, then we'll talk through really their big picture. So when are they planning to access these funds? Do they have a lot saved in IRAs? They can't access the IRAs till they're 59 and a half. So when are they planning to retire? So kind of marrying all of these different facts of the portfolio to get to, okay, what are we comfortable with? What are their goals? When do they plan to access it? And really putting it all together through that.
Got it. So one clarification, this person, they got a big inheritance, right? Can they put that in a 401k? Can they put that in an IRA? What are their options on the account type?
Yeah. So they would be subject to the same contribution limits that the plans would have. So your 401k, so that really is generally payroll deduction. That's going to be better answered by you, but it's usually payroll deduction, not just cash in your bank account. And then on the IRA, if they qualify, so depending on their circumstances, so this client makes between $300,000 and $400,000 a year, so they're not going to be able to put it into a Roth IRA directly, but we could maybe do a backdoor Roth, but that would still be subject to those annual contribution limits.
Got it.
Which I think this year is $7,500.
Yeah, this comes up a lot, a question I get, which is why I brought it up. And you're exactly right, is in this situation, unfortunately, you would not be able to just take that lump sum and put a big chunk of it into the 401k because it has to come through payroll. So an important clarification is it does need to either go into an IRA with a plan of a backdoor Roth or something like that, depending on the plan, or into a brokerage account where you have less restrictions. So I think that's a key detail. So that's helpful. I think another question that you've probably been through, I know I have, is you do this for a client, right? They give you the $1 million. You decide on an appropriate allocation based on their goals and their risk tolerance. You put it in the market, you invest it appropriately, and then the market goes down 20%. How would that play out? What are some of the things that you would tell that client?
Yeah.
Walk me through that.
Yeah. So the whole function of, meeting with the client and gauging their volatility and their independent risk tolerance portfolio is really trying to figure out, okay, what can they stomach? Because if I have them invest in day one all in and then the market tanks and they turn around and they take it all out, they sell it while the market's down, then it's way more harm than good was ever done. So that's why we really want to walk through, here are the scenarios, here are our options, here is what could happen, and figure out what they're comfortable with. So if for that $1 million example, so if we put, $250,000 in day one and the market goes down, well, let's talk through that. So first, they didn't need the money anytime soon,
Right.
because we've already done the planning. Yeah. We've already done the planning to say anything that you need to access in the next 2 years, we want to set aside in cash. And so we know they don't need the funds. So while it might hurt and it might be like, ooh, not feel good, they don't need the funds, so they have time to recover in the market. So that's the biggest key, is making sure we don't invest anything needed for short term, because that's how you lose money in the market, is having to sell when the market's down. And so we first would remind them of that. Hey, you don't need the access to these funds. We have time to weather the storm. But the second piece is, if the market does go down, if we didn't do a lump sum right away, we've got cash on the sidelines. And everybody loves a good sale.
Exactly. Yep. Why not buy at a discount? Yep.
Yeah. Why not buy good holdings at a discount? And so that's an opportunity.
Right.
But it's all working with the client to make sure that they can stomach that, and
Got it.
that they've got the risk tolerance to withstand that.
So let's change this situation a little bit. Let's say they got this inheritance.
Mm-hmm.
It's $1 million, and they may need $500,000. Maybe they're going to buy a house, to go back to our previous episode.
Yeah.
They don't know, but they're thinking about it, and they might buy a house in the next 3 to 5 years.
It's a possibility.
Would that change how you handle this $1 million and where you put it?
So if it kind of depends on how serious they are. If they're like, oh, we've kind of talked through it, then we may still invest it maybe in a less risky portfolio. If they're like, we've really been talking about this, we really think it's something we're going to be doing, then we might put it in our cash hub. So our cash hubs they're designed to earn yield, but not be subject to full market volatility. So they're getting, I believe when we last looked, around 3.75% yield in the money market funds. And so that's still something. It's not nothing. But we would kind of walk through, how serious are they with that? And then, of course, we have the option, because remember, these are going to be in taxable accounts. We are going to be investing it in an account that could put a securities backline of credit in place.
Correct. That's kind of where I was going, is if nothing else, you're adding to the capacity or the potential amount you could borrow using something like an S-block in a taxable account, which is cool. We're connecting dots.
We're connecting dots.
This is good. What other potential downsides is there to doing the lump sum? Let's say they're on board, they agree with the Vanguard study, and they say, I'm willing to take the risk and the volatility, I'll live with it. What could go wrong?
So what could go wrong is we pick a time and invest when the market is down, and it ends up being in that piece that is the 32% of the study that didn't do as well in the lump sum. But that's always the risk. But if we've got a long time horizon, then it likely will still end up being a good option and a good choice in the looking back, because really it's about time in the market. So you want the power of compounding. If we put the money all in day one, and then we have several years of growth, then that compounds over time. So you're not leaving money on the table with the cash in the sidelines.
Got it. So another hypothetical scenario, because I think this is often a time when people engage a financial advisor, right? Maybe they haven't worked with one before. All of a sudden they have a family member pass away.
Yeah.
And they now find themselves with a big chunk of money that they didn't have before. And they engage us because they say, hey, I have this $1 million. I don't have a plan today. Help me.
Yeah.
What would be the first thing that you walk them through and just starting the conversation with a plan with our firm?
Yeah. So the first thing that we'll walk through is really building that plan together. So if you've never worked with an advisor, you've maybe never seen a balance sheet, which is just a list of everything you own and all the money that you owe. And so we'll first put together, okay, let's categorize, this is what you own. These are the tax qualifications of them, kind of where they fall in that. And this is what you owe in these different spaces, your interest rates, and really gather all the details of the financial picture. And then that's step one, is just the financials. But step two is, how do you feel about them? What are your goals? When are you wanting to retire? And so building through all the ways that clients think about and feel about their money and making plans together for that.
Yeah. No, I love that. And like I said, on my side of the house, on the 401k side, it's a talking point that I give is a lot of times it is when people sell a business or they all of a sudden receive an inheritance that's sort of the gateway into reaching out to a financial advisor.
Absolutely.
So that's very helpful.
Well, and we only see, so clients will only change advisors a handful of times in their lives. Right. So maybe they have an advisor at that time, but the advisor hasn't been, hands-on in their planning. They haven't been reaching out regularly. They don't feel like they've got a solid relationship with that advisor. So maybe they already work with an advisor, but maybe that advisor is no longer suited to their needs. Maybe they need another advisor that can help them with more hands-on planning. So we see that too. It's either the time to seek an advisor for the first time or to evaluate the advisor relationship you currently have.
Got it. No, it makes sense. Let's say somebody says, you know what? I want to do some of it lump sum. Let's use the $1 million.
Yeah.
Then. I'm comfortable putting half of it in. What would you recommend they do with the other $500,000? Would you dollar cost average it over a time frame? Most likely. I mean, what options do you have if you kind of split the strategy?
So I want to take a quick step back because we did build a couple of different outcomes in our hypothetical financial plan with our hypothetical clients. So we have first the option to invest everything today lump sum. And so when you look at the financial plan for the client that we had built out, that was about a $3 million gain over the lifetime of their portfolio. If we dollar cost average, so this specific dollar cost average was a little bit further out than we probably would go, but we wanted to give kind of guardrails. So this one was $250,000 a year over the next 4 years.
Okay.
And so in that result, it was about $2.7 million in value gained.
Okay.
So obviously if we left it in cash and, cash is earning yield right now, but who knows what tomorrow will bring. So we assumed little to no growth in cash long-term because that's still our long-term cash assumptions. And so obviously that $5.5 million portfolio stayed similar. It was a similar outcome to if they left it in cash. So it would just grow regularly. But so those were the two kind of outcomes that we built out for today's podcast. But conceptually, if a client said, okay, I want to put half to work now and then the other half to work over a certain amount of time, I usually like to give our Gatewood Investment Committee as much freedom as possible. And really that's because they're the ones watching the market. They're the ones studying it every day. It's what they do. It's the whole function of why they exist. And so I really like to give them full autonomy to put the funds to work as they see fit. So I'll first ask the client, do you want to make sure that we stretch this out over 6 months or a year if they have any individual preferences? If they don't, and they're just, I don't really want to put it all in right away, but I don't have a preference around time frame, then I like to give the investment committee full autonomy so they can put it to work as they see fit because they'll see there might be a day where the market goes down unexpectedly and it's like, oh, this is a great buying opportunity. I like them to have the freedom to be able to act on that.
Yeah, no, I completely agree. And I love that. I'm going to brag about our firm a little bit, but I love the fact that it's not on Nina or Micah to pick the investment strategy and the timing, that we can truly focus on the plan and listening to the client and rely on the team of experts on a separate investment committee that's what they do and that's what they're focused on, I think is a really cool differentiator that we have.
It's one of my favorite pieces of our firm.
I agree. Because at the end of the day, we should be focused on the client and the broader plan and not get into the weeds. We're not a one-man band, as we like to say. We're a symphony at Gatewood, and we need different instruments to shine. So I completely agree.
Yeah.
Well, cool. I think we tackled a lot of it. Is there anything else you'd like to share about just the question of invest lump sum now, wait, space it out, anything around that?
No, I think the overarching theme is really just making sure that you're working with an advisor you're comfortable with and that there's listening to you. Because if you don't feel good and you're not bought in on the plan for putting those funds to work, you're much more likely to take them out unexpectedly at probably an inopportune time. Absolutely. So just making sure you take that time to really evaluate if that advisor that you're working with is the right fit for you, you feel heard, because it's a team effort, right? We don't want to just dictate to a client how things should be done because there's the research, but there's also the behavioral piece of what feels right too. Right. Yep. So I think just making sure that you've got a good partner.
I love that. Well, I think that's a good place to end.
Awesome. Thank you for joining us today. for episode 4 of Beyond the Advisor. If you liked what we went through today, go ahead and subscribe. We do release new podcasts every month. And if you want to walk through one of these scenarios with one of the advisors at our firm, please visit gatewoodwealth.com and we'd be more than happy to walk you through it.